After more than 3 decades of helping people retire and stay retired, I've come to believe something that may surprise you. The biggest threat to retirement probably isn't your portfolio. It's not your investment returns. I've watched hundreds of people retire, and the ones who enjoyed it the most, who felt secure, who never seemed to worry, they usually weren't the ones chasing the highest returns. They were the ones who consistently made better decisions. Still today, many people believe that retirement is mostly an investment problem. Build a good portfolio, earn a good return, everything else takes care of itself. That is only a piece of the puzzle. It is not the whole picture. Retirement isn't an investment problem. It's a decision-making problem. And the quality of your retirement isn't determined by one big financial choice. It's determined by many small choices working together over years. And that's why I think the biggest mistake people make is in the belief that they are getting comprehensive financial planning when they aren't. Because the mistakes that hurt people the most are the ones that they don't know about. They're the opportunities they never knew existed. Today, I am going to show you one of them. Hello, everyone, and welcome back to the Financial Fast Lane. I'm Lane Martinson. If you're new to this channel, my goal is simple: to make complicated retirement and financial planning decisions easier to understand, and so that you can make better decisions with greater confidence. When I first started in this profession, I spent a lot of time talking about investments. Like most advisors entering the business, I thought investments were the center of retirement planning. And don't misunderstand me, investments matter. They matter a lot. But something interesting started happening year after year, meeting after meeting. I began noticing a pattern. The clients with the happiest retirements weren't always the ones with the largest portfolios. They weren't always the ones earning the highest returns. Often, they were simply people making better financial decisions. Their Social Security decision supported their tax strategy. Their tax strategy supported their income strategy. Their income strategy supported their investment strategy. Everything worked together. And that's when my thinking changed. I stopped viewing retirement as a collection of separate financial decisions. And I started seeing them as one connected financial system. Because every financial decision impacts another financial decision. Let me show you what I mean. Imagine two couples. You have John and Mary and David and Susan. Both retired age 65. Both saved about the same amount. Both worked hard. Both were responsible. Both earned similar investment returns. 5 years later, one couple is clearly in a stronger financial position. Why? It wasn't because they had found some magical investment. It wasn't because they took greater risks. It wasn't because they paid lower advisory fees. It was because dozens of small financial decisions were coordinated. Social Security optimization, the timing and the size of Roth conversions, withdrawal order, income strategies, taxes, Medicare, required minimum distributions, estate planning, charitable giving. None of those decisions by themselves completely change retirement, but together they change everything. And that's something I've seen over and over again throughout my career. I remember sitting across the table from a retired couple several years ago. They had done almost everything right. They had saved diligently, they had stayed out of debt, invested consistently. They weren't looking for a miracle. They simply wanted someone to confirm that they were on the right track. As we reviewed their retirement, we discovered several opportunities that they had never been shown. None of them involved chasing higher returns. None required taking additional investment risk. Instead, they involved coordinating financial decisions. Each opportunity seemed fairly small, but together they had the potential to improve their retirement by hundreds of thousands of dollars over time. I'll never forget what they said. They said, "Lane, nobody has ever explained retirement this way before." And that conversation has stayed with me, and I've heard some version of it from clients again and again over the years. The greatest opportunities in retirement planning are often hidden, not because they're complicated, but because they're not looking at the whole picture. Not all financial advice is the same. In my experience, it generally falls into 3 different categories of financial advisors, and each level provides a different level of value to their clients. Here's a visual. I call it the advisor value pyramid. Now, there are ethical professionals serving clients at every level of the industry. It's not my intent to criticize. The purpose of this illustration is to help you understand the differences and the scope and the value that each provide. Level 1, the broker. This is the level where the majority of financial advisors work. At the broker level, there's typically no financial planning provided, or possibly some planning, but with a very limited scope. The primary role here is helping clients select and implement specific financial products. But there are many different types of brokers as well. Some brokers are insurance-only products, such as annuities and life insurance. Some brokers are investment products only, such as mutual funds and stocks and bonds. There's often a good amount of bias that comes into play because of their specific product offerings. If your objective is simply to purchase a financial product, there are many brokers that will help you do that. At the broker level, because the scope of planning is limited, important opportunities and potential risks are more likely to be overlooked. Level 2 is templated planning. At this level, the scope expands. The focus shifts from individual products to traditional rules of thumb and templated financial planning, as well as managing an investment portfolio. For many families, this is a tremendous improvement over the more common transaction-based services of brokers. But it is still limited in scope and more static and less proactive than can be found at the engaged holistic planner level. The highest level available is found at the engaged level. Holistic planning is far less common, and as a result, most people have never experienced it. Many of the biggest financial opportunities exist where different financial planning disciplines intersect. One simple example would be a Roth conversion. It isn't just a tax decision. It affects Medicare premiums, Social Security taxation, required minimum distributions, legacy planning, charitable giving, and future tax brackets. Those connections are easy to overlook when each planning decision is considered in isolation. The advisors at the top of the pyramid can provide everything offered at the lower two levels. They do so within a coordinated, comprehensive planning process that considers how each financial decision affects other financial decisions, including portfolio management, retirement income strategies, product recommendations when appropriate. Nothing is taken away. The scope simply becomes broader. Instead of asking, what is the best investment, the question becomes, what is the best overall decision? Because every financial decision creates consequences somewhere else. Taxes impact retirement income. Retirement income impacts Medicare. Medicare impacts healthcare costs. Investment withdrawals impacts taxes. Estate planning impacts family outcomes. Social Security impacts withdrawal strategies. Everything is connected. And those connections create both risks and opportunities. The greatest value often isn't found in optimizing one decision. It's found in coordinating hundreds of interconnected decisions over many years. And that's the difference between financial planning and proactive, holistic financial planning. The whole really is greater than the sum of its parts. To me, the top of the pyramid is also a financial stewardship. A financial plan is something that gets created, but a financial stewardship is something that you practice. One happens on a particular day, the other continues month after month and year after year. Because retirement isn't static. Life changes, markets change, inflation changes, tax laws change, families change, goals change, which means your financial decisions should continue to evolve as well. Imagine flying from Phoenix to Boston. Before takeoff, the pilots carefully prepare a flight plan. But the airplane almost never follows the exact route. There are storms, headwinds, air traffic, weather. Course corrections happen all the time. Not because the destination changed, but because the conditions changed. Retirement works the same way. The goal isn't following the original plan perfectly. The goal is arriving where you want to go. There is value in a good financial plan, for sure, but the greater value is in making better financial decisions year after year as life changes. Better questions lead to better decisions. Better decisions create better outcomes. And better outcomes create greater confidence. If you'd like an easy, practical book that explores these ideas in more detail, my book, The 5W Retirement Blueprint, is available on Amazon in 3 formats: paperback, Kindle, and Audible. It's written to help you better understand the principles we've been discussing and how they can help you make more informed retirement decisions. In this video here, I explain the Roth IRA rules that are often misunderstood, and I look forward to seeing you in the next episode of the Financial Fast Lane.